So let's talk a little bit about investments. The whole point of our video today is to talk about the 3 myths of investing. This should be the only video you ever have to watch on investments. I know that sounds crazy, but when you finish watching this video, you'll understand what I mean. So before we get started, past performance is no indication of future performance. Please pause this video and read the disclaimer. Now let's go over some basics. If you've seen my earlier vlogs, you'll know that anything in the upper left is better and anything in the lower right is worse. Return or compound annual growth rate is plotted on the vertical axis, and maximum drawdown, or the money that you would have lost back in 2008, 2009 typically, is on the horizontal axis. Myth number 1, investments are complicated. And the implication is, so then I can't understand them, and I have to listen to the professional who's telling me that my portfolio has to be complicated to protect me. Myth number 2, I have to take high risk to get good returns. The subtitle is Bonds are for Wimps. Myth number 3, the S&P 500 is hard to beat. So let's examine each one of those myths. The first one, myth number 1, investments are complicated. You'll be able to see from these graphs, the big white sphere is the total portfolio, and all of the smaller spheres are the components that make up the total portfolio. So you can see from this example, when we go from conservative to moderate to aggressive, what's happening here? Well, we're getting no more return for taking more risk. That doesn't make any sense, does it? I mean, come on, you're a smart person. If you're going to take more risk, you expect more return, right? I would. And you can see from these 3 charts how complicated these portfolios are. So instead of taking these 9 components I showed you in the complicated portfolios, we're going to skinny this way down and show you just how uncomplicated your portfolio can be. So now we're going to create a portfolio using only 2 components. And those 2 components are very simply the S&P 500 or SPY, which was in the more complicated portfolio. But we're going to use government treasuries. And why just government treasuries? Now, government treasuries are included in the aggregate bond index, AGG, but government treasuries are the safest investment that you can put your money in the entire world today. By the way, that feeds into our definition of diversification. Government bonds are a totally safe haven asset. They're totally different than the S&P 500, which is a risk asset. So by putting your money in government treasuries, perfectly safe, and putting your money in the S&P 500, risky, you've diversified your portfolio right there. So now when we take a look at these portfolios, and by the way, we're going to use the ETF IEF for the conservative and moderate portfolios. IEF invests in 7 to 10 year government treasuries. And then for the aggressive portfolio, we're going to use a different ETF called TLT, which invests in government bonds with an average duration of about 20 years. So now when you look at these 3 portfolios and we go from conservative to moderate to aggressive, you can see that in the aggressive case, we're still getting 99% of the return of the S&P 500, but we only have 54% of the maximum loss of the S&P 500. And by the way, instead of 100% exposure to risk assets as you have if you invest all your money in the S&P 500, in this case you only have 60% exposure to those risk assets. If we back off a little bit and go to the moderate portfolio, you're still getting 80% of the return of the S&P 500, but only 33% of the maximum drawdown. And by the way, 60% of your money is in safety, totally safe government treasuries, while 40% is exposed to risk. And if you want to step back one more and go to the conservative portfolio, over the long haul, you should get about 75% of the return of the S&P 500, but only 17% of the maximum drawdown. And by the way, 80% of your money is in totally safe government treasuries. So as you can see, myth number one, investments are complicated. You don't have to have complicated investments to get good results. And we've shown that here with these 3 simple portfolios using 2 ETFs. Now on to myth number 2. I have to take large amounts of risk to get good returns. As you can see from these portfolios, as I add bonds into the equation, so I mix bonds with the S&P 500, I don't give up much return, but I get rid of a lot of the loss. This is a really good trade-off. So finally, on to myth number 3. The S&P 500 is hard to beat. So there are many ways to beat the S&P 500. First of all, you could invest in the NASDAQ 100, so invest in something else. Typically, a smaller basket of stocks will outperform a larger basket of stocks. So as you can see from this chart, just investing in the NASDAQ 100 beats the S&P 500 over the last 10 years. You can also invest in the Guggenheim ETF RSP, which is an equal weight S&P 500 ETF. And I know there are mutual funds out there that do this. So by equal weighting the S&P 500, you're not putting all the emphasis on the bigger stalwart companies that are the largest companies in the S&P 500. Enough said about that. So another option is to spend over half your life like I did, along with a brilliant MIT electrical engineer and mathematician, and a very savvy Wall Street investor who was a professional trader in several hedge funds and at a large bank, and come up with algorithms that'll select stocks that will handily outperform the S&P 500. And you can see we've done that here. We created natural selection algorithms that, when we create the natural selection 7 portfolio, obviously handily outperforms the S&P 500. We decided, well, hey, okay, we want to go for maximum growth. That's great. But what about if you want to pick stocks that are likely to perform well, but with much less risk? So we created a different success factor, ran natural selection on it, and we're able to create a portfolio called the Natural Selection 10, which has very, very good risk characteristics, but still outperforms the S&P 500. We created the Natural Selection 50 that you see here, which has 50 stocks in it. And then we created the Natural Selection 100, which has 100 stocks in it. This can manage very large AUM on the order of 100 or 200 billion, maybe even $300 billion. Using algorithms, we created portfolios that very handily outperform the S&P 500. So what's the point of all this? Why is this the only video that you need to watch before you invest? Look, you can do this yourself. You can see the portfolios are very simple. Buy some government treasuries, buy some S&P 500 or some NASDAQ. Decide how much drawdown you can stand before you decide how you're going to allocate, and then allocate accordingly. And be smarter than all these people out there. So look, when it comes to your money, your hard-earned money, only you can decide how you want to manage it. Decide how much maximum loss you can stand. Create a simple portfolio, and you'll be able to sleep at night, and your investments will do well, and you won't have to pay somebody a lot of fees. Thank you for watching today, and if you like this video, please click on the subscribe button below and leave some comments. I'll be happy to start a dialogue with you. Until next time, that's all for now.
Don't get worried. Hey, who's that waiting there? Who's that down the street? Yeah, look. That's her. I think I'm gonna go out the back way. I'll see y'all later. Oh, I ain't going out there.